Welcome to Griffonomics.
Glad to be here.
You know, when you look at the stock market today, there is just, well, there is so much noise.
Endless noise.
Right. Just daily price swings, analysts yelling over each other on financial news networks, trying to predict what the Federal Reserve will do next or, which microchip company is going to post a beat.
Yeah, it gets deafening.
It really does.
Yeah.
But you are here because you want to get past all that noise. You want to understand the actual mechanics of how market disruptions happen.
Exactly. You want to see the gears turning beneath the surface.
Right, to understand how companies either build these unassailable economic fortresses or just kind of crumble under the weight of their own inefficiency. And today, we are pointing our lens at a company that is fundamentally rewriting the rules of the property casualty insurance sector. I'm talking about the Progressive Corporation.
It really is a fascinating case study in what happens when a legacy mathematically conservative industry just collides head-on with modern ruthless data science. We are talking about a company that has taken one of the oldest business models on Earth, which is pooling risk, and turned it into this hyper-efficient algorithmic engine.
So the mission of this deep dive is to generate a granular, highly strategic report and investment roadmap for you. We are going to explore how Progressive is completely disrupting its sector through what we are calling a data-first underwriting model.
It's all about the data.
But here's the central paradox, right?
Yeah.
This is the massive tension that makes this deep dive absolutely necessary right now. Progressive just delivered a jaw-dropping 40% return on equity in 2025.
Which is wild.
Totally wild. They posted a company-wide combined ratio of 87.4. They generated over $17 billion in operating cash flow and basically had the most successful year in their nearly 90-year history.
Yeah, I mean, by every traditional financial metric, they completely knocked the cover off the ball. A 40% return on equity in a heavily regulated financial sector. That's the kind of number you usually only see in, aggressive tech startups, not nearly century-old auto insurers.
But here is the paradox. Despite all of that, despite breaking their own records and defying industry gravity, Progressive stock has suffered a 30% decline over the past year.
It is a massive disconnect.
Right.
You have a company operating at absolute peak financial efficiency, creating this moat of data that their competitors literally cannot touch, and the broader market has effectively penalized them for it.
Yeah.
The market is looking at a mountain of cash and treating it like a mirage.
So today, we are going to bridge that disconnect. We're going to start by analyzing this relentless underwriting machine they've built and how they are aggressively filtering risk.
Crucial step.
Then, we'll unpack a massive behind-the-scenes capital leverage pivot that most of the market just completely missed.
Yeah, people really overlooked that.
From there, we have to dissect a billion-dollar anomaly that happened down in Florida, which honestly is one of the strangest regulatory stories I've ever seen. And finally, we will deliver the verdict on what appears to be a rare 11.5x valuation opportunity.
Sounds like a solid roadmap.
Let's jump into it. To understand where this stock is heading in the future, you first have to understand the sheer mechanical efficiency of the engine driving it today.
Right.
So let's look at 2025. It was an absolute financial blockbuster. Progressive brought in $87.67 billion in total revenues.
Huge number.
Yeah, and they achieved an underwriting profit margin of 12.6%. But the number that just jumps out is that combined ratio, an 87.4 company-wide combined ratio.
That's the magic number.
So for the uninitiated, can you sort of translate the mechanics of the combined ratio? Why is this the single most important number in this industry?
Sure. So the combined ratio, or CR, is basically the holy grail metric for any property and casualty insurance company. It measures the money flowing out versus the money flowing in from the actual business of underwriting.
Okay.
And this is completely separate from whatever money they make investing in the stock or bond market.
Right, just the pure insurance side.
Exactly. The math is relatively straightforward. It is the sum of the company's incurred losses. So paying out claims, and their operating expenses divided by their earned premiums.
Got it.
If a company has a CR of exactly 100, it means they are breaking even on their insurance policies.
So no profit, no loss.
Right. They are paying out exactly as much in claims to fix wrecked cars, plus the salaries of their adjusters and the electricity for their offices, as they take in from premiums.
Right.
Anything under 100 means they're actually making an underwriting profit. For decades, the industry average has often hovered right around 100, meaning most insurance companies actually don't make money selling insurance.
Right. Really?
Yeah, they make their profit by taking your premium dollars and investing them in bonds until you file a claim. But Progressive, well, they have historically maintained a strict, publicized internal target to always hit a 96.0 or better.
Which means historically they've targeted a 4% profit margin just on the underwriting side before investments even come into play.
Precisely. And earning 4 cents on every premium dollar is a fantastic business model when you're writing tens of billions of dollars in premium.
Right, volume makes it work.
But posting an 87.4, I mean, that means for every single dollar they take in as premium, they are only paying out 87.4 cents in claims and expenses.
Leaving them with a 12.6% margin.
Exactly. And in the property and casualty insurance world, which is traditionally a low-margin, highly commoditized business where consumers just, shop around for the cheapest rate, a margin that thick is almost unheard of at this scale.
It represents a fundamental shift, doesn't it? From traditional broad strokes risk pooling to hyper-segmented, data-driven underwriting.
Totally. They aren't just guessing who is a safe driver or a safe homeowner by looking at their zip code or their age anymore. They know exactly who's going to cost them money.
So let's break down where that 87.4 is coming from, because obviously not all insurance is created equal. When we look at their segment mix, personal lines, which is your standard personal auto insurance, is clearly the dominant force here. It accounts for 87% of their net premiums written.
It's the core engine.
And they actually grew their policies in force, their active customer base, by 13% in personal auto. They added almost 5.5 million more vehicles to their books in a single year.
Yeah, that kind of growth, while simultaneously expanding profit margins, usually defies the laws of business physics.
Right. Usually if you want to grow fast, you have to lower your prices and accept thinner margins.
It is the ultimate testament to their pricing models. But the real story of underwriting discipline is happening in their property segment, the side of the business that insures homes.
Right. This is fascinating.
They instituted a strategy internally called the Blueprint for the Future. And this strategy allowed the property segment to achieve an unbelievable 75.1 combined ratio.
A 75.1 CR in homeowners insurance. I mean, that almost sounds like a typo given the climate volatility we've seen lately. How are they achieving a nearly 25% profit margin on homes when other carriers are, going bankrupt from wildfires and hurricanes?
They did it through ruthless, calculated risk selection.
How so?
Well, most legacy insurance companies are addicted to top-line revenue growth. They have this massive network of local agents who just want to sell as many policies to as many people as possible to earn commissions.
Right.
Progressives took a step back and let their data scientists run the show. They looked at the models and realized that writing homeowners insurance in coastal, hurricane-prone areas or in Midwestern hail-prone states introduces massive unpriced volatility to their balance sheet.
So what do they do?
Instead of just petitioning state regulators to let them raise rates on everyone to cover those catastrophic losses, they actively shrank their footprint in volatile markets.
Wow.
Yeah. They intentionally declined to renew policies. They saw a 16% decrease in policies in force in those specific weather-related markets. But they didn't stop there. For the customers they did keep, they fundamentally changed the mechanics of the policy.
This is where we need to dig into the how. What does changing the mechanics of a policy actually look like for a homeowner?
Let's take roof damage, which is a massive driver of property claims. Historically, if a massive hailstorm destroyed your 15-year-old roof, standard homeowners insurance would pay the replacement cost.
Okay.
They would write you a check for $20,000 to put a brand new modern roof on your house. From an insurer's perspective, that is a huge loss severity.
Right.
Progressive's Blueprint for the Future aggressively rolled out roof depreciation schedules in vulnerable states. This means if that same hailstorm hits, the policy only pays the actual cash value of a 15-year-old roof. They calculate how much the roof has aged and depreciated, and maybe they only write you a check for $8,000.
Leaving the homeowner to cover the rest.
Exactly. They also mandated specific higher deductibles just for wind and hail damage. So instead of a flat $1,000 deductible for any claim, if it's a windstorm, your deductible might be 2% of the home's total value, which could be $10,000.
So by shifting that financial burden back onto the homeowner, Progressive dramatically slashed their own loss exposure.
Precisely.
And beyond the depreciation schedules and the deductibles, there is a structural mandate they placed on new customers that I just found fascinating. If you want a Progressive homeowners policy now, In many of these markets, you can't just walk in and buy one. They strictly require new home policies to be bundled with an auto policy.
Yeah, a mandatory bundle.
It feels like they are acting as a bouncer at an exclusive high-stakes club.
Oh, that's a good way to put it.
Right. They are standing at the door, looking at the line, and they are actively turning away the bad risks, like a house sitting on a hurricane coastline or a standalone property policy in Tornado Alley, and just saying, sorry, we're at capacity, you aren't getting in. But even for the good risks, the VIPs who live inland with new roofs, they are forcing them to check their coats to get inside. The mandatory bundling is the coat check. You want our home insurance. You have to give us your car insurance, too.
That bouncer analogy captures the exact dynamic at play, and forcing the VIPs to check their coats is a brilliant stabilization tactic.
How so?
The actuarial data is crystal clear on this. Customers who bundle home and auto, the ones Progressive internally calls Robinsons, are the most valuable demographic in the industry.
Robinsons, okay.
Yeah. They stay with the company much longer, which means that their customer lifetime value goes up while the amortized cost of acquiring them goes down.
Makes sense.
Furthermore, the data shows they generally file fewer claims, and when they do, those claims are often less costly. So not only is Progressive avoiding the catastrophic weather risks, but the business they are writing is inherently stickier, more predictable, and vastly more profitable.
So the culmination of all these granular changes, shedding coastal risk, depreciation schedules, mandatory bundling, is what generated that staggering 75.1 combined ratio in the property segment.
Absolutely.
But if we extrapolate this out, we have to consider what this means for the broader market. If Progressive is successfully abandoning these risky coastal and hail-prone areas, drastically reducing their exposure to climate volatility and making massive profits while doing it, what happens when the other mega carriers look at these earnings reports and decide to follow their lead?
It's a critical macro question. If the most sophisticated, data-driven insurers all realize that certain geographies are simply uninsurable at a price that consumers can actually afford, well, we're looking at a massive reshaping of the housing and real estate market.
Yeah, that's terrifying for homeowners.
We are already seeing the early stages of this in places like California with wildfire risk and Florida with hurricane risk. You start to see the creation of insurance deserts where private capital simply refuses to underwrite the risk.
And then what?
The only option left for a homeowner is a state-backed insurer of last resort, which is often incredibly expensive and offers bare-bones coverage. Progressive's blueprint is proving mathematically that running away from bad climate risk is incredibly profitable for shareholders. That is a loud, flashing signal that the rest of the insurance industry will absolutely pay attention to.
And generating this level of underwriting profit, turning 12.6 cents of every dollar into pure margin, it creates a very unique corporate challenge. Progressive suddenly found itself sitting on a massive, growing pile of capital.
A very good problem to have.
Right. But if you're a standard tech company, you just throw that cash into research and development or buy back a bunch of stock. But insurance is different. You can't just do whatever you want with your money. Regulators dictate how much cash you must hold in reserve.
Exactly.
Which leads us to a brilliant, behind-the-scenes regulatory maneuver that occurred in 2025. It's an inflection point that completely reshaped their balance sheet. It's called the operating leverage pivot.
This is one of those highly technical financial moves that rarely makes the front page of CNBC or Bloomberg, but it is the absolute engine of shareholder value creation.
Right.
Understanding this pivot is essential to understanding why Progressive is generating such massive returns on equity.
Let's outline exactly what happened. In 2025, Progressive secured regulatory approval from key state insurance departments to increase their premium-to-surplus ratio limit from 3.1 to 1 up to 3.5 to 1.
Yep.
And just to contextualize, this approval was for their personal vehicle insurance companies, which represent 91% of Progressive's entire net premiums written. But before we get into the financial impact of this, we need to define the mechanics. What actually is a premium-to-surplus ratio? Why do state regulators care so deeply about this specific metric?
To understand this, you have to look at the core function of an insurance regulator. Their primary job is not to ensure the company makes a profit. Their job is to ensure the company remains solvent, so that when a citizen crashes their car or their house burns down, the company actually has the money to pay the claim.
Right. They are protecting the consumer.
Exactly. The premium-to-surplus ratio is the ultimate measure of that solvency. Think of it as a safety cushion or a regulatory speed limit.
Okay.
The premium is the amount of risk the company is taking on by writing insurance policies. The surplus is essentially the insurance company's statutory equity. the actual tangible capital they hold in reserve to pay out claims if things go terribly wrong and their predictive models fail.
So what's the standard limit?
Historically, the National Association of Insurance Commissioners, the NAIC, has viewed a 3-to-1 ratio as the absolute maximum safe speed limit, meaning for every $1 of surplus capital you hold in the vault, you are allowed to write a maximum of $3 worth of premium risk.
It's a hard cap on your growth.
Mm-hmm.
Even if millions of people want to buy your insurance, you legally cannot sell them a policy unless you have enough corresponding cash sitting in your surplus vault.
Precisely. It prevents insurers from growing recklessly, taking in premium dollars, spending them on lavish corporate expenses, and then going bankrupt when a catastrophe hits.
But Progressive had a slightly higher limit.
Yeah. Progressive had generally operated with a slightly elevated 3.1-to-1 limit based on their historical stability. But in 2025, because their financial condition is so robust and their underwriting algorithms have proven to be so statistically precise year after year, regulators essentially audited their balance sheet and agreed to raise the speed limit.
Wow.
They said, "You are so exceptionally good at pricing risk, we will allow you to operate with a thinner safety margin. You can now write $3.50 of premium for every $1 of surplus."
And the capital efficiency results of this single regulatory approval are staggering. By being allowed to stretch that ratio from 3.1 to 3.5, Progressive instantly freed up approximately $1.6 billion in capital in 2025.
Instantly.
They didn't have to sell off any real estate. They didn't have to lay anyone off. They didn't have to invent a new product.
Yeah.
That $1.6 billion was just suddenly unlocked from the regulatory vault simply because the math allowed them to be more levered.
It's pure leverage.
And what they did with that money is the key to the investor story. They moved that freed capital out of the highly restricted regulatory layer and shifted it up to the additional capital layer at the holding company. This direct capital maneuver is exactly what fueled their extraordinary 13.50 per share variable dividend that they paid out to shareholders in January 2026.
If we look at the mechanics of an insurance balance sheet, it helps to visualize the capital stack as a 3-story building.
Okay, I like this.
At the ground floor, you have regulatory capital. This is the foundation. It is untouchable money required by law to stay solvent. You cannot use it to pay dividends or buy other companies.
Got it.
The second floor is contingent capital. This is a buffer layer that the company chooses to hold above the regulatory minimum just to be safe.
Okay.
The penthouse at the top is additional capital. This is the excess cash, the truly free money that management can use to fund new growth initiatives, acquire competitors, or return to shareholders as dividends.
Which is exactly what they did.
Exactly. By convincing regulators to approve a higher multiple, that 3.5-to-1 ratio of Progressive fundamentally changed the architecture of that building. They shrank the size of the regulatory capital ground floor they are required to maintain, which mathematically pushed $1.6 billion straight up into the additional capital penthouse.
Right.
And because they are now holding less idle cash against their premiums, their overall comprehensive return on equity skyrockets. The denominator in the return on equity equation got smaller, so the return gets bigger. It is a masterclass in capital efficiency.
Hold on, I want to challenge the premise here. Raising the leverage limit sounds great for cash flow and paying out massive dividends, but aren't they just stripping away their safety net?
That's the counter-argument, yes.
If you are holding less capital in reserve relative to the billions of dollars in premiums you are writing, what happens when the models are wrong? What happens if a massive 1-in-200-year catastrophe hits? If a Category 5 hurricane wipes out a huge portion of their insured properties, or a massive systemic event like a severe recession combined with unprecedented supply chain inflation causes a massive spike in auto claims, isn't that thinner cushion a severe threat to their solvency?
It is the exact question every risk officer and regulator asks, and it's the reason most companies are never granted a 3.5 ratio. But this is where Progressive's specific layered capital structure provides the defense.
How so?
Remember that middle floor we just talked about, the contingent capital?
Right, the buffer.
Progressives didn't just empty the vault. They specifically designed and funded that contingent layer using advanced probabilistic modeling to absorb exactly what you just described, a 1-in-200-year catastrophic scenario.
Oh, wow.
They have run the Monte Carlo simulations. They have stress tested their portfolio against historical worst-case scenarios. Their goal is that even if a massive, unprecedented disaster occurs, the financial losses would eat entirely through the contingent layer, but stop before ever breaching the required regulatory ground floor.
Ah, so the safety net is still firmly in place. It's just structured and quantified with far more precision than a generic industry rule of thumb.
Exactly. And to fully understand their safety net, you have to look at how they invest all this capital while they're waiting to pay claims. When Progressive takes your premium dollar, they don't just put it in a checking account, they invest it.
Right.
But they aren't putting this money into highly volatile equities, risky venture capital, or illiquid private credit like some aggressive life insurers do to chase yield.
Where's it going?
Progressive has an investment portfolio that scaled to $97.4 billion in 2025, and it is highly liquid. The vast majority of it consists of fixed income and short-term treasury securities. The portfolio maintains an AA average credit rating, which means they are lending money to highly secure entities, primarily the U.S. government and top-tier corporations.
Yeah.
Crucially, the portfolio has a very short average duration of just 3.5 years.
Why does that matter?
Because auto insurance claims are short tail, meaning when you crash your car, the claim is usually settled and paid out within a few weeks or months. So Progressive must keep its assets highly liquid. They can't lock their money up in 30-year bonds.
That makes perfect sense.
So even if that 1 in 200-year event happens tomorrow, they have nearly $100 billion in highly liquid, top-tier assets they can convert to cash immediately to pay claims. The duration of their assets perfectly matches the duration of their liabilities. The safety net is incredibly robust, which is why the state regulators felt entirely comfortable raising the leverage limit and allowing them to unleash that $1.6 billion.
So they've optimized the underwriting to an 87.4 ratio, and they've optimized the capital structure to a 3.5 leverage limit. But this brilliant maneuvering wasn't happening in a vacuum.
No, it wasn't.
It was fueled by a fiscal year so wildly, unexpectedly profitable that down in one specific state, the government actually intervened and forced them to give money back to the public.
Yeah, the Florida situation.
This brings us to our review of the 2025 financial realities and the Florida Paradox. We already touched on the record-breaking company-wide numbers, a 40% comprehensive return on equity and $11.3 billion in net income.
Staggering numbers.
But hidden inside those massive macroeconomic figures is a highly specific line item called the Florida credit. It was a $1.2 billion policyholder credit expense.
This single line is one of the most unique and telling financial stories of the entire year for Progressive. It perfectly illustrates the tension between hyper-efficient private market data and state-level statutory regulations. It's a clash between the algorithms and the law.
Let's walk through the mechanics of how a company could be forced to refund $1.2 billion to its customers. The state of Florida has a specific consumer protection statute. It legally caps the amount of profit an insurance company is allowed to earn on personal auto policies.
Right.
And they measure this over a rolling, contiguous 3-accident-year period. So in this specific case, the regulators were looking at the 3-year window from 2023 to 2025. Now, to understand why Progressive suddenly breached this cap, we have to look back at what happened in Florida in 2023.
Florida was a very tough market.
Historically, Florida was a nightmare for auto insurers. It was plagued by an environment of extreme litigation, often referred to as social inflation, where massive billboards encouraged drivers to sue insurers for minor accidents, and specific laws allowed contractors to take over policy benefits and aggressively sue companies for inflated claims.
Right, the assignment of benefits crisis.
Exactly.
Yeah.
But in 2023, Florida enacted sweeping, historic tort reform and insurance legislation. These new laws were explicitly designed to curb frivolous lawsuits, eliminate one-way attorney fees, and crack down on insurance fraud. Because of that new law, the legal environment changed overnight.
It was a massive shift.
Progressives lost costs in Florida. The money they actually had to pay out for legal settlements and inflated medical claims absolutely plummeted. Their reserve development became highly favorable because the massive lawsuits they had modeled for simply stopped happening.
And here is where the story gets fascinating. Progressive recognized this massive drop in costs. They saw the data changing in real time, and they actually took proactive actions to lower their rates for consumers.
Wait, really? They cut rates?
Yes, they filed for rate decreases with the state. They weren't trying to gouge the Florida drivers. They were adjusting to the new reality. But their internal underwriting models are so incredibly accurate and their operational efficiency is so high that even after lowering rates, the profit margins they generated in Florida for that 2023 to 2025 period were immense. They blew right past the legal statutory profit limit.
It's like a regulated public utility. Imagine a state utility commission telling a power company, to protect the public, you are only legally allowed to charge enough to make a 10% profit.
Right.
But Progressive's engineers figure out how to generate electricity so incredibly cheaply and efficiently that even when they charge the absolute lowest rates in the entire state, their profit margin hits 15%.
That's a great analogy.
Because the law is the law, the state commission steps in and forces them to issue a rebate to every household to bring the margin back down to the legal limit.
Exactly what happened.
And the logistics of this refund are massive. Progressive had to accrue $1.2 billion on their balance sheet as an expense. And that money isn't just a fine paid to a state slush fund. It is being distributed pro rata, meaning proportionally, to all active Florida personal auto policyholders based on the premiums they earned in 2025.
It's a massive wealth transfer back to the consumers.
To put into perspective how dominant their underlying business is, if they hadn't been forced by law to record this $1.2 billion expense, their company-wide personal lines margin wouldn't have just been great. It would have been an absolutely incredible 14.2%.
What is vital to understand here is the precedent this sets for regulatory risk moving forward.
Okay, let's talk about that.
It highlights a very real friction point for investors. Progressive has built an algorithm and a business model designed to maximize profitability through granular data analysis. But state insurance commissioners are politically appointed or elected officials tasked with protecting consumers from paying too much for mandatory insurance.
Yeah.
When a company becomes so efficient that their baseline operational profit breaches legal statutory caps, it creates a bizarre corporate disincentive. Progressive is essentially being penalized for its own data-driven efficiency.
Looking at this from an investor's perspective, does this Florida refund set a dangerous precedent? Could other states suddenly look at Progressive's 40% overall return on equity, look at their own state laws, and decide, hey, we should implement a rolling 3-year profit cap too? Could this state-level regulation effectively cap Progressive success nationwide?
It is a highly rational fear, and it's a risk factor that the market and analysts must actively price into the stock. In the United States, insurance is regulated entirely at the state level, not by the federal government.
Right, 50 different fiefdoms.
You don't deal with Washington, D.C., you deal with 50 different state insurance commissioners, each with their own political pressures.
Yeah.
Now, Florida's market was notoriously uniquely broken, which is why they needed the 2023 tort reform in the first place, so the profit cap was a specific legislative lever tied to that unique history. It's unlikely you will see a wave of 40 other states suddenly implementing identical statutes tomorrow.
Okay, that's somewhat reassuring.
But you are absolutely right that other states could look at this $1.2 billion refund and see a populist mechanism to force rebates back to voters.
For sure. So how does Progressive handle this?
For Progressive management, the immediate operational challenge is how they manage this dynamic in 2026. Because Florida uses a rolling 3-year period, those highly profitable post-tort reform years of 2024 and 2025 will still be factored into the statutory calculation next year.
The rolling window catches them again.
Right. So Progressive must proactively manage its profitability down in Florida in 2026. They might have to aggressively cut premium rates further, or perhaps vastly increase their marketing spend within the state, intentionally lowering their operating margins so they don't trigger another massive mandatory refund.
Wow.
They literally have to intentionally tap the brakes on their own profit machine.
Which is just a wild position for a publicly traded corporation to be in. Intentionally figuring out how to make less money so you don't get penalized for making too much.
It's a very unique problem.
But it begs the fundamental question. How did Progressive get so ruthlessly efficient at pricing risk that they literally broke the profit ceiling? How do they know with such certainty who was going to crash their car and who isn't?
It's all about the moat.
Right. The answer lies in a technological moat that they have been quietly building for over a decade. And that brings us to the core engine of their disruption: innovation, the AI Strategy Council, and their massive telematics moat.
If capital leverage is the engine of their financial returns, their technology and data assets are the fuel. This is the data alpha we talked about at the beginning.
Data alpha.
Right. In modern finance, alpha is the ability to generate excess returns above the market average.
Right.
Progressive is generating alpha not through better stock picking, but through vastly superior data.
Let's look at how seriously they take this. They haven't just assigned a couple of rogue software developers to look into artificial intelligence. They formed a dedicated AI strategy council.
Yeah, it's a top-level initiative.
This council is tasked specifically with projecting 3 to 5 years into the future to model how generative AI will impact the insurance industry. And they aren't just writing theoretical white papers, they are actively deploying the technology into their daily operations.
Absolutely.
For example, they have integrated a customer-facing generative AI assistant into a new text and email platform. Instead of a human adjuster having to read an email, figure out what the customer needs, and type out a response, the AI handles automated claims tasks, requests documentation, and executes follow-up actions instantly.
It's a huge efficiency gain.
But the one that really caught my eye is their use of something called Gaussian splatting for claims analytics. This isn't just a chatbot.
No, Gaussian splatting is a fascinating technological leap. Without getting bogged down in computer science, it is an advanced rendering technique that takes standard 2D photographs or a quick video taken on a smartphone and uses neural networks to instantly construct a highly detailed, photorealistic 3D model of a scene.
Okay, so how does that apply to insurance?
Think about the traditional claims process. A driver gets into an accident. They have to wait days for a human claims adjuster to drive out to a tow yard with a clipboard, walk around the wrecked car, take pictures, and manually estimate the structural damage. It is slow, expensive, and prone to human error.
Right.
With Gaussian splatting, a customer or a tow truck driver can just walk around the crashed vehicle taking a 30-second video on their iPhone. The AI ingests that video, builds a perfect 3D spatial model of the car, and algorithms instantly analyze the structural damage.
That is incredible.
It can calculate the depth of a dent, assess frame damage, cross-reference it with parts catalogs, and generate a repair estimate down to the bolt in seconds. It entirely bypasses the manual inspection phase, drastically lowering the operating expenses we talked about earlier.
And they are even using AI on the customer acquisition front. They produced their first entirely AI-generated television commercial titled Drive Like an Animal. The AI generated the script, the visuals, the voiceovers. It drastically reduced their production time and costs, allowed for rapid A/B testing, and still drove strong consumer engagement.
It's impressive across the board.
But while the AI commercial is a fun, highly visible marketing win, and the claims automation saves millions in expenses, the true unassailable power of Progressive lies in their data ingestion, specifically their telematics.
AI models are ultimately only as good as the data they are trained on. You can have the most sophisticated neural network in the world, but if you feed it garbage data, it will give you garbage predictions.
Makes sense.
And nobody in the property and casualty insurance industry has a data set quite like Progressive. They have been pioneering usage-based insurance, or UBI, for decades.
Let's detail the evolution of this telematics moat. Most people know it as the snapshot program. If you are a certain age, you remember the commercials for this little hardware dongle that Progressive would mail to you, and you had to crawl under your steering wheel and plug it into the OBD2 diagnostic port of your car.
I remember those.
It felt like very advanced tech at the time. Then, as smartphones became ubiquitous, Snapshot evolved into a mobile app on your phone. It used the phone's GPS and accelerometer to track your speed and detect hard braking.
Right.
But now, they have evolved to the absolute bleeding edge. They have developed the unique ability to ingest driving data streams directly from the original equipment manufacturers, the OEMs. Meaning, if you buy a modern connected car from Ford, GM, or Toyota with your consent, Progressive is pulling the driving telemetry directly from the car's internal computer systems over the cellular network.
This transition to OEM ingestion is the essence of data alpha. Over the years, Progressive has collected and analyzed tens of billions of miles of actual real-world driving data.
Tens of billions.
Yeah. They know exactly how speed, time of day, hard braking, cornering G-forces, and rapid acceleration correlate to the mathematical likelihood of an accident.
Wow.
This creates an insurmountable intellectual property moat. If a competitor, say a new venture capital-backed insurtech startup, wants to challenge Progressive today, they can't just buy a software package off the shelf.
Right.
They cannot simply replicate decades of machine learning trained on billions of miles of driver behavior overnight. The math takes time to learn, the models need massive sample sizes to reach statistical significance, and Progressive has a massive head start.
The difference between the smartphone app and the OEM data is staggering. It's like moving from a clunky old Fitbit that merely guesses how many steps you've taken based on your wrist swinging back and forth
No.
to a surgical monitor directly wired to your heart in an intensive care unit.
That's a perfect analogy.
The smartphone app might think you slammed on the brakes, but maybe you just dropped your phone on the floorboard. The OEM data ingestion is the ultimate unfiltered truth of how a person actually drives. You can't trick the car's internal telemetry. It knows exactly how hard the brake pedal was compressed, at what exact speed, on what exact road.
Exactly.
And what is genuinely compelling is how this technology doesn't just exist to ruthlessly price risk. It powers broader company initiatives that blend this tech efficiency with real community impact. For example, because their core business is so efficient, they have the financial flexibility to launch programs like Up Payment and the Open the House campaign in 2025.
Right, the community initiatives.
They're using their corporate resources to advance homeownership education and affordability, helping first-generation homebuyers secure homes. It shows that the data advantage translates into capital flexibility, allowing them to invest back into the communities they serve, which in turn builds immense brand loyalty.
If we look at the strategic picture, the telematics data and the AI capabilities are dual-purpose weapons. Yes, they allow Progressive to segment risk and price policies with surgical precision, which leads directly to that incredible 87.4 combined ratio we started with. But equally important, this technology is a massive customer acquisition engine.
How does it drive acquisition?
Think about the psychology of the consumer. The people who are willing to sign up for Snapshot, who willingly agree to share their internal car data with an insurance company, are generally self-selecting safe drivers who want a lower rate because they know they are safe.
Well, that makes total sense.
Right. A reckless driver who speeds and runs red lights is never going to volunteer to have their driving monitored. So the technology actively attracts a very specific, highly lucrative demographic. It becomes a self-fulfilling cycle. Better data attracts better drivers. Better drivers have fewer accidents, which generates better profits, which allows Progressive to lower rates further, attracting even more safe drivers.
Which transitions us perfectly to market dynamics and competition, or what Progressive internally refers to as the destination era. Because all this sophisticated tech and data isn't just sitting in a research lab, it is actively, aggressively capturing market share in the real world.
Oh, absolutely.
In 2025, Progressive gained nearly 2 points of market share in private passenger auto, bringing their total slice of the national pie to approximately 18.5%. They added nearly 3.7 million new policies in a single year.
We really need to pause and recognize how difficult that is.
Right.
Auto insurance in the United States is a mature, highly saturated, fiercely competitive market. Everyone who drives already has insurance. So if you are growing, you aren't finding new customers, you are stealing them from your competitors.
Exactly.
Gaining 2 full points of market share in a single year at this scale is a massive structural shift. It proves that their pricing algorithms and their digital acquisition funnels are operating on a completely different level than their legacy peers.
And the core of this growth strategy is this concept of the destination era. They are hyper-focused on capturing a customer demographic they internally refer to as Robinsons. As we touched on earlier with the bouncer analogy, Robinsons are the customers who bundle their auto and home insurance.
The Holy Grail.
To capture these Robinsons, Progressive hasn't just relied on clever television commercials. They have built out massive, highly sophisticated digital comparison platforms. Home Quote Explorer, or HQX, Auto Quote Explorer, AQX, and Business Quote Explorer, BQX.
Contrast this approach against pure-play auto insurers who only sell car insurance and refuse to touch the property market. Progressive realizes that the bundled customer is the real prize. Customers who bundle stay longer. Their retention rates are vastly higher.
Because it's hassle to move everything.
Exactly. If you only have car insurance, it's easy to switch to a competitor to save $20 a month. But if your car, your house, and your motorcycle are all bundled together on one bill, the friction required to switch companies is much higher. This lowers Progressive's long-term customer acquisition costs. And statistically, homeowners are more stable, resulting in lower claims costs across the board. The destination era is about moving Progressive's brand from being just the place you go to get cheap car insurance online to being the single destination for your entire financial and insurance life.
But looking closely at these digital platforms, I noticed something that doesn't track logically for me at first glance. On these HQX and BQX platforms, Progressive is literally offering side-by-side quotes from unaffiliated third-party competitors.
Yes.
If I'm a consumer and I go to Home Quote Explorer on Progressive.com, I can buy a policy from a direct rival carrier right there on Progressive's website. Why on earth would they willingly sell a competitor's policy? Doesn't that directly cannibalize their own sales and defeat the purpose of capturing market share?
It seems entirely counterintuitive, almost like cannibalization, until you understand the sheer genius of the aggregator agency model.
Okay, unpack that.
Go back to what we discussed in the property segment regarding the blueprint for the future. Progressive knows exactly what kind of risk they want to hold on their balance sheet and exactly what kind of risk they want to avoid. They want inland homes with new roofs. They absolutely do not want weather-prone coastal homes in hurricane paths.
Right.
Well, what happens if a customer who lives on the coast of South Carolina comes to Progressive's website wanting to become a Robinson? They want to bundle their auto and home.
Okay.
Progressive desperately wants the auto policy because their telematics models show it will be profitable, but they absolutely refuse to take on the hurricane risk of the home policy. If they just say no to the home policy, the customer will leave and take their auto business to a competitor who will bundle them.
Right, they lose the auto policy too.
So, through HomeQuote Explorer, Progressive solves the problem by acting as an independent agent. They sell the customer a Progressive auto policy, taking on the risk they want, and then, right there on the platform, they sell the customer a homeowner's policy from an unaffiliated third-party carrier who is willing to take on coastal risk.
Oh, I see. So Progressive earns a commission and fee-based revenue for acting as the agent on the home policy, but they take on zero underwriting risk for the house. If a Category 4 hurricane hits South Carolina and levels the house, the competitor pays the massive claim out of their surplus, while Progressive just cashes the commission check.
Exactly. Meanwhile, the consumer is locked into the Progressive digital ecosystem. They have a seamless bundled experience. They view Progressive as their provider.
That's brilliant.
Progressive does the exact same thing for specialty products they don't even underwrite, like complex pet health insurance or classic antique car insurance. They monetize the customer lead, earn risk-free commission revenue, and provide a unified experience for the consumer without polluting their own perfectly calibrated balance sheet with unwanted volatile risk. It is a brilliant strategic moat. They are essentially operating the Expedia or Kayak business model for insurance, capturing the fees while someone else flies the plane.
So let's pause and synthesize everything we've covered so far. We have spent this time detailing a perfect storm of corporate excellence. They have an industry-defying 87.4 combined ratio. They executed a regulatory leverage pivot that unlocked $1.6 billion in capital, fueling a massive 13.50 special dividend. They survived a $1.2 billion regulatory refund in Florida and still posted record profits. They have an insurmountable AI and telematics data moat tied directly to OEM vehicle computers. They grew their market share by 2 full points in a saturated industry. And they have this brilliant aggregator platform locking in the most profitable bundled customers while passing off the catastrophic climate risk to their competitors.
It's an incredible run.
With all of this overwhelming, record-breaking, data-driven success, you would think Wall Street would be throwing a parade. The stock should be skyrocketing to all-time highs every single week. Instead, as we noted at the very beginning of this deep dive, the stock cratered. It lost 30% of its value over the past year.
Yeah.
Why the massive disconnect? What are the institutional analysts seeing that we aren't? This brings us to market skepticism and risks.
The 30% decline is a textbook example of a phenomenon in financial markets known as multiple compression. This happens when the actual earnings of a company hit record highs, but the broader market becomes terrified of the company's future prospects. Because investors are scared, they are willing to pay less for each dollar of those earnings. So the earnings go up, but the stock price goes down because the multiple the market applies to those earnings shrinks.
So what exactly is Wall Street terrified of? If the engine is humming perfectly today, what is the boogeyman hiding in the future? The data points to market fears of margin normalization and increased competition, alongside specific looming macroeconomic headwinds like fears of tariffs on imported auto parts and severe labor inflation driving up future loss severity.
To understand the psychology of the market here, you have to look backward at the recent historical trauma the insurance industry endured. After the COVID-19 pandemic, there was a massive, unprecedented supply chain crisis. Semiconductor shortages halted car production. As a result, both used and new car prices absolutely spiked.
Right, cars got super expensive.
Think about how this impacts an auto insurer. If a customer totals their 5-year-old Honda Civic, the insurance company has to cut them a check to replace it. Before the pandemic, that might have cost $12,000. Suddenly, because of the supply chain crisis, replacing that exact same used Civic cost $18,000.
A huge jump.
This massive, sudden surge in loss severity, the cost of fixing or replacing vehicles, decimated auto insurer margins across the entire industry between 2021 and 2023. The predictive models broke. The industry had to aggressively petition state regulators to raise premiums drastically just to recoup those lost margins and stay solvent.
Oh, that's the
By
trouble.
the end of 2024 and into 2025, those rate increases finally earned their way into the books, and margins were restored, which is exactly what drove Progressive's record 12.6% profit margin. But the market is terrified that history is about to repeat itself.
Because of the tariffs.
Exactly. Analysts are looking at the geopolitical landscape and the potential for new tariffs on imported auto parts. If a tariff makes an imported bumper, windshield, or sensor suite 20% more expensive, the cost of repairing a fender bender skyrockets. They are also looking at union labor negotiations driving up mechanic wages. Wall Street fears that loss severity is going to spike all over again, and that Progressive's massive profit margin is going to normalize back down to mid-single digits as competition forces them to cut prices to maintain their growth trajectory.
It sounds to me like Wall Street analysts are just suffering from post-COVID inflation PTSD. They got burned so badly by the sudden, unpredictable spike in car prices a few years ago that they're now seeing ghosts of margin compression everywhere, even when the data shows there currently are none.
I think post-COVID PTSD is a highly accurate assessment of the market psychology right now. If you contrast the market's fears with the actual real-time data on the ground, the panic seems vastly overblown.
What does the data say?
Look at Progressive's blended auto combined ratio in the first quarter of the year. It was a highly healthy, roughly 86.5%. And they are not showing any signs of margin deterioration. Furthermore, if you look at the broader macroeconomic data, used and new car price inflation is actually very muted right now. Inventories on dealer lots have recovered. The massive spikes in vehicle costs have leveled off, completely defying the tariff fears that Wall Street was aggressively pricing into the stock.
Now, to be fair and balanced, we do have to address their commercial lines segment, because there is legitimate pressure there. The commercial segment insures things like heavy trucking, delivery fleets, and small businesses. The data notes that commercial lines generated an 89% combined ratio. Now, an 89% is still highly profitable, but they saw a 4% drop in earned policies. They are losing business there.
Yes, the commercial auto space, particularly long-haul trucking and last-mile delivery, has faced severe pressure. Jury verdicts in accidents involving commercial trucks have skyrocketed, another form of social inflation. But again, look at how Progressive's management handles this adversity. They aren't stubbornly chasing unprofitable growth just to satisfy Wall Street's desire for top-line expansion. They are actively optimizing margin over growth in the commercial sector. They willingly non-renewed certain unprofitable trucking policies.
Okay, so they're protecting the bottom line.
Moreover, they are heavily utilizing reinsurance contracts to protect their balance sheet. Reinsurance is essentially insurance for insurance companies. Progressive is ceding a portion of their commercial premiums and passing off the corresponding liability for catastrophic losses to global reinsurance partners.
Smart.
Recently, global reinsurance rates have actually deflated slightly, giving Progressive a highly cost-effective tool to mitigate pressure in the commercial space. They are highly proactive. When a segment underperforms, they shrink it and reinsure it until the math works again.
And what about those Wall Street fears of labor inflation and general operating costs? Even if car parts don't spike, the cost of running a massive corporation, paying salaries, and maintaining offices is getting more expensive.
This is where we can connect the dots back to the AI Strategy Council and the Gaussian splatting we discussed earlier. Progressive has immense scope to leverage its artificial intelligence and automation investments to fundamentally reduce its non-claims operating costs.
Of course.
By automating massive swaths of back-office functions, utilizing AI for complex document classification, instantly estimating damage with 3D models, and handling routine customer service via generative AI assistants, they can strip out massive amounts of operational overhead. This provides a deep structural buffer.
Right.
Even if premium inflation slows down or if claim severity does tick up slightly due to mechanics charging more for labor, their rapidly falling internal operational costs can defend that bottom line margin. They are not a helpless legacy carrier waiting to be crushed by inflation. They are a tech company engineering their way out of it.
So, If the market skepticism is largely driven by overblown post-COVID PTSD, and the underlying data proves the operational engine is actually humming flawlessly, that creates a massive mispricing scenario for the informed investor. The market panicked, looked at the macro headlines, and sold off a best-in-class asset. Which brings us to our final destination, the final verdict and the 11.5x opportunity.
This is where all the granular data, the telematics moats, and the capital leverage pivot converge into a concrete investment thesis.
The strategic outlook from the financial analysts is exceptionally clear. Progressive is rated as a high-quality conviction by why? Because of that 30% panic sell-off over the past year, the stock is currently trading at a massive discount to both its own historical averages and its direct industry peers. It's currently sitting at just 11.5x earnings.
An 11.5x earnings multiple for a company generating a 40% return on equity with a technological moat that competitors cannot replicate is a striking anomaly in today's market.
Yeah, that seems way too cheap.
Analysts evaluating this space view a 13x to 13.5x multiple as the appropriate, historically accurate fair value target for this specific company. Expanding the multiple back to that fair value range sets a clear price target above $220 per share.
And if you look at quantitative screening tools, they back this up. Seeking Alpha's valuation screener grades Progressive with a B+E. We are looking at projected forward earnings of roughly $17.00 per share. And management isn't just relying on their current momentum, they are actively supporting future earnings through a strategic framework they call the three horizons.
The three horizons.
Right. They are execute, expand, and explore. They are executing by maintaining their dominant 87.4 CR in their core personal auto business. They are expanding by pushing into commercial lines and refining the property segment through the destination era. And they're exploring entirely new adjacencies, utilizing their aggregator platforms to monetize life insurance and pet insurance leads without taking on the underwriting risk.
If we synthesize everything we've unpacked today, this is exactly why analysts view Progressive as the premier compounder in the entire financial sector.
Yeah.
You have a company with an incredibly clean, bulletproof balance sheet, highlighted by a highly conservative 21% debt-to-capital ratio. You have an unleveraged foundation that just secured regulatory approval to free up $1.6 billion in surplus.
Right.
You have highly sustainable capital returns, offering a reliable 1.3% baseline dividend yield, augmented by the proven willingness to pay out massive special variable dividends like the 13.50 they just distributed to shareholders.
Exactly.
And critically, because the stock price has compressed so much due to unfounded market fears, the valuation risk that existed a year ago when the stock was priced for perfection has essentially been removed. You are buying into a fundamentally superior, data-driven business model at an absolute bargain price.
So to synthesize this entire deep dive for you, Wall Street priced in a disaster. They panicked over ghosts of inflation, tariffs, and margin compression. But the underlying mechanics, the 87.4 combined ratio, the OEM telemetry moats, the brilliant capital leverage pivot, the strategic shedding of coastal property risk, and the AI-driven cost reductions proved that the disaster simply isn't coming.
It's just not there in the data.
The market's irrational, backward-looking fear has created a rare, wide-open window. You have the opportunity to buy a best-in-class technology company that just happens to be disguised as a legacy insurance carrier at an 11.5x discount.
It really is a fascinating intersection of granular data science, masterful capital management, and irrational market psychology. But if we want to look even further down the road, past the next quarter's earnings report or the next dividend payout, there is one final provocative thought I want to leave you with.
Oh, I like the sound of that.
Throughout this deep dive, we talked extensively about Progressive's massive telematics database. They have a decade of experience, not just insuring regular drivers, but insuring transportation network companies, the TNCs like Uber and Lyft. They understand the data of commercial fleet driving better than anyone.
Okay.
At the exact same time, we see the rapid, steady advancement of autonomous vehicles. Companies like Waymo and Tesla are logging hundreds of millions of miles, mapping cities, and perfecting self-driving technology. Progressive's management themselves have stated they are well-positioned for changes in mobility, whatever they may be.
Where are you going with this?
This raises an incredible existential question for the future of this entire industry. As we move toward a world of autonomous robotaxis, a future where human error, which is the root cause of the vast majority of accidents today, is removed from the road entirely, what happens to car insurance? Will the ultimate culmination of this data alpha be the day when Progressive stops insuring human drivers altogether? Instead of pricing the risk of a teenager driving a Honda Civic, will they become the ultimate underwriter of the AI algorithms driving the cars?
That is mind-blowing.
When the car itself is the driver, Progressive's unique ability to ingest OEM computer data and mathematically measure the safety of differing AI driving systems could make them the only financial institution on Earth capable of accurately pricing the risk of the robotaxi revolution. They wouldn't be insuring people, they would be insuring the code.
That is a wild thought to mull over. From a bouncer checking coats at the door of the property market to the ultimate financial underwriter of artificial intelligence itself, the evolution of this company is truly remarkable. Thank you for joining us on this journey through the data, the paradoxes, and the mechanics of market disruption. Risk defined, portfolio protected.